Welcome to the comprehensive review of the Fidelity OTC Portfolio, also known as the FOCPX fund. Fund reviews are essential as they provide investors with insights into the performance of various funds. Today, we're diving into the FOCPX fund, a key player in the current investment landscape. We'll be comparing it against other Fidelity portfolios using metrics such as the compound annual growth rate, standard deviation, and the Sharpe and Sortino ratios. In the meantime, subscribe and comment on what funds you would like me to analyze in the future. Let's dive into the heart of the matter, the performance metrics. We're going to compare Fidelity OTC, Fidelity MSCI Information Tech ETF, and Fidelity Select Semiconductors, three portfolios with their unique strengths and nuances. Let's start with Fidelity OTC. With an initial balance of $10,000, it ballooned to $48,613. Its compound annual growth rate, or CAGR, hit a decent 16.83%, although the journey wasn't always smooth, as evidenced by a standard deviation of 18.56%. Its best year saw a growth of 46.79%, while its worst dipped to negative 32.12%. The maximum drawdown was a hefty negative 34.8%. However, with a Sharpe ratio of 0.87 and a Sortino ratio of 1.38, it showed a favorable risk-adjusted return. Moving on to Fidelity MSCI Information Tech ETF. This portfolio turned the initial $10,000 into $63,097. It had a higher CAGR at 19.86%, and a slightly higher standard deviation at 19.09%. Its best year outperformed Fidelity OTC, with a growth of 53.30%, while its worst year was a tad better at negative 29.59%. The maximum drawdown was similar at negative 32.42%. It also had a higher Sharpe ratio and Sortino ratio, signifying a better risk-adjusted return. Finally, we have Fidelity Select Semiconductors. This portfolio took the initial $10,000 and transformed it into a staggering $117,406. This portfolio had the highest CAGR at 27.41%, albeit with a higher standard deviation, indicating greater volatility. Despite having the highest maximum drawdown at negative 40.74%, it also had a high Sharpe and Sortino ratio, showing a strong risk-adjusted return. These metrics provide a clear picture of how these portfolios have performed over the years. Now, let's take a closer look at some key observations and drawdowns. We've seen three Fidelity portfolios in play, each offering positive returns over the specified period. However, their risk and volatility levels differ. The Fidelity Select Semiconductors portfolio had the highest compound annual growth rate, indicating the highest annualized return. In contrast, the Fidelity MSCI Information Tech ETF showcased the lowest volatility among the three portfolios, suggesting a potentially steadier ride. However, it's crucial not to overlook the Sortino ratio. The Fidelity OTC portfolio had the highest Sortino ratio, implying a favorable risk-adjusted return, especially focusing on downside risk. Now let's navigate the choppy waters of drawdowns. The largest drawdown happened from January 2022 to September 2022, with a magnitude of minus 34.08%. It took about a year and 5 months to recover from this dip. The shortest drawdown was a 1-month stint in September 2021, with a magnitude of minus 5.14%. Throughout the analyzed period, drawdowns varied in both frequency and severity, some shorter and less severe than others. These observations and drawdowns give us a deeper understanding of the risks involved and the potential for recovery. Remember, investing isn't just about chasing returns, it's also about understanding the risks and being comfortable with the possible downsides. Understanding drawdowns and their recovery periods is crucial for assessing potential risks. Now, let's examine the top 10 holdings of FOCPX and its expense ratios. The majority of FOCPX's assets, almost 60%, are held in just 10 companies. These include tech giants like Microsoft, Apple, and Amazon, each accounting for over 8% of the fund's total assets. Other key holdings include Alphabet, Nvidia, and Meta Platforms. Moving on to expense ratios, a crucial factor to consider when investing, we find that FOCPX has an expense ratio of 0.7%. Comparatively, the Fidelity Select Semiconductors portfolio has a slightly lower expense ratio of 0.69%, while the Fidelity MSCI Information Tech ETF boasts the lowest expense ratio of just 0.08%. However, it's important to remember that lower expense ratios don't always equate to higher returns, and the FOCPX has consistently demonstrated strong performance over time. It's essential to consider both holdings and expense ratios when choosing a portfolio. As we wrap up our review, let's summarize the key takeaways. Fidelity OTC, MSCI Information Tech ETF, and Select Semiconductors portfolios all demonstrated positive returns, with varying levels of risk and volatility. Highlighting the star performer, Fidelity Select Semiconductors racked up the highest compound annual growth rate, pointing to the maximum annualized return over the specified period. On the other hand, Fidelity MSCI Information Tech ETF presented the lowest volatility, making it the most stable among the three. Yet, it was Fidelity OTC that boasted the highest Sortino ratio, indicating an attractive risk-adjusted return, especially considering downside risk. Pivoting to the FOCPX fund, despite its lower return and higher expense ratio compared to similar funds, it still remains a solid growth fund. But remember, when it comes to investing, the devil is in the details. Always take into account your financial goals and risk tolerance. Remember, choosing the right portfolio depends on your individual financial goals and risk tolerance. Always do your due diligence before making investment decisions. After all, this is not financial advice, and consulting a professional would give you personalized advice tailored to your situation.